Dencun is set to go live on ETH mainnet on March 13th. And this is a huge moment for the Ethereum community, who has just been bag holding while everything else rips for the past few months. Obviously, EIP 4844, which is going to introduce data blobs, and that's going to kind of set the foundation for dank sharding in the future. I think L2 tokens are kind of primed to rip off of this because transaction fees are going to go down significantly. And hopefully you see some applications arise that will just bring on a whole new wave of entrants to the L2s.
What's up, everyone? Welcome back to another episode of 0x Research. March is just around the corner, and I wanted to make sure to give you a quick reminder to not top tick your prices of your DAS London tickets. If you use codes 0x10 at checkout, you can lock in a 10% discount on your ticket. Don't miss out on your chance to get ahead of the curve. I'll see you in London.
What's up, everyone? Welcome back to another episode of 0x Research. Today is Monday, February 12th. This should air on Wednesday, February 14th. And today we are joined by 0x Pibblez and Matt from the Blockworks research team to jam on the latest market happenings. Ren, do you want to kick us off with some governance updates?
Yeah, for sure. So first is the interesting tweet that caught our eyes this morning on sort of like the effectiveness of the Arbitrum STIP program. So Alberto_crypto on Twitter put out some interesting statistics. We'll link the post, the tweet in the show notes later. So overall, the program drove a $400 million increase in TVL, and it basically cost the Arbitrum DAO $54 of incentives for every new address. And overall, the program resulted in roughly 27 million of additional fee revenue, which works out to $1 of fees for every $2 in ARB. So in VC land, there's this thing called LTV and CAC. LTV stands for lifetime value. CAC stands for customer cost of acquisition, or customer acquisition cost, right? So at least just for this Arbitrum STIP program, it has a LTV to CAC ratio of 0.5, which means you're kind of losing money. You're spending more money to acquire a customer than the money that you're making from a customer. And in terms of Arbitrum, the only money that you're making is sequencer profits, right? Normally, VCs want to see a ratio of 3x of the lifetime value to the customer acquisition cost. So overall, I don't think this was as effective as individuals thought, but that's like a relatively superficial statement, right? Like, it drove an increased number of TVL. You don't know how much these additional new addresses that came in will basically help drive future profits. So it kind of remains to be seen. Anyone have thoughts around the incentive program design and perhaps like what KPIs the DAO should be incentivizing for or optimizing for in the future?
I guess one thing that comes to my mind is that this was an experiment and it was looked at and it was posed in that light. So even though maybe it didn't have the success that it could have, I think that there'll be a lot of good lessons learned for future incentive programs. So that's definitely another barometer or like important metric to take into account, which is what lessons can we learn for future incentive programs. The Arbitrum DAO has already actually voted and passed additional LTIP long-term incentive program. So they'll be giving out way more incentives in the future. I just think it's important that that program takes into account the lessons learned here. And if it manages to do so successfully, then this can be looked at as a win. Of course, spending more money than you actually, the metrics that you pose are not looking so good. But at the same time, I just think that's another important thing to keep in mind.
I'd like to see the rewards actually vest over 6 months, let's say, and then you can only claim that month's allocation as the user if you were active on Arbitrum that month, just so the value of the customer over the lifespan of the incentives that you paid out is a little bit longer. I think there's a lot of room for improvement on incentive proposal design, and hopefully, like Matt said, they incorporate some of the lessons learned into the long-term incentive program that they just passed on the forum the other day.
Yeah, and if you compare it to the other competitor, you look at Optimism's retroactive public good funding, and like you see like Synthetics and Velodrome got a little bit of rewards, but then you see a lot of the OP get wasted on random initiatives. Like, I'm going to translate the Optimism white paper to Korean, pay me $250,000. So it's like, if these are our two models, at least Arbitrum's is, a little bit more successful and useful for the ecosystem.
Yeah, I would definitely agree with you there. All right, next up on news, we have Solana fee market designs, it's been getting a decent amount of attention lately. So for those that have been listening, Solana fee markets are a little broken today, not completely broken, but relatively broken, especially the isolated fee markets. So there's a few things at play here. Solana's base fee is fixed per signature, which means that no matter how many compute units or in Ethereum land gas your transaction uses, you pay the same base fee. However, priority fees are priced per compute unit requested, but 50% of it is burned and the other 50% of it is distributed or passed on to the validator. The scheduler today, or like the default scheduler implementation, also has some wonky issues with it. It doesn't work as well as it should, and it results in sort of transaction placement or inclusion being pretty non-deterministic and add in some network jitter. And it basically means that a lot of the time you don't pay for what you get in terms of your transaction being included fast enough or at like a high enough part of the block. This is being partially fixed in 1.18, but overall there's still an incentive to spam, right? Some statistics from Jito is that 58% of compute is wasted by failed arbitrages and 98% of arbitrage transactions fail. And for example, 50% of priority fees being burned means that out of protocol payments are encouraged. So there's a few problems at the core here. One is inefficient compute unit usage and requests because different compute units, different transactions carry different compute units and those cost the same base fee. And the second one is it's costless to write lock accounts. When you sort of write a transaction on Solana, you need to specify which accounts you are touching, or if you're more familiar with Ethereum, which pieces of state that you want to interact with. But this doesn't cost anything. And so you could quote unquote DDoS or spam Solana just by sending in infinite number of transactions that write lock accounts. So for example, one attack vector is write locking a Oracle update account, right? If you keep on write locking that and the actual Oracle update doesn't get priority, then the Oracle price feed basically would never update. So there's one ongoing proposal that's very much being debated right now, and it's called SIMD 110 or 0110, and it's basically an exponential fee for write lock accounts. It increases the fees in a targeted manner over time to reduce the incentive to spam. And how it works is it basically proposes tracking the exponential moving average of each account's compute unit utilization per block, and the cost of right locking an account would increase exponentially based on its respective trailing compute unit utilization. So it's kind of like EIP 1559, but much more granular for specific accounts and every single account that exists on Solana. However, the Fire Dancer team doesn't really like this proposal in its current state, and they're going to draft a counter proposal. But overall, I think the main takeaway is that Solana fee markets are pretty broken today. There's a lot of active debate and discussion that's ongoing, but we haven't found the optimal solution yet. And I think Solana will be forced to find a solution in this year. If not, when users 10x, when activity 10x, something will likely break. That was a bit nerdy, but anyone have any thoughts?
It kind of reminds me just of back in the day, and it feels like a lifetime ago, but before EIP 1559, like you'd constantly log into MetaMask and have transactions get dropped on Ethereum. That's a lot how it feels like interacting with Solana today when it gets pretty busy. It's tough to get a transaction in. So I think it's just a testament to the fact of how novel Solana is, and there's still a lot of iteration to be done, but I'm definitely looking forward to like a more baked out fee mechanism because I think it'll make the chain like 10x better.
Yeah, I definitely see both sides of it, which is on one side, Solana's a pretty nascent network. They're trying to, like you said, novel. It's trying to achieve a lot of new and innovative things. So, facing difficulties early in its life cycle is not only expected, but it's 100% likely like that was going to happen. So I do think, Solana's a great network. I think it's really has a good user experience. And even though sometimes in times of high congestion, it gets hard to get transaction in, hopefully and likely it will be fixed. On the other side of that, even the solutions posed today aren't, don't fix the whole problem, and there'll likely be more problems in the future. I don't think it's like as simple as just adding, a fee that exponentially increases depending on the number of write locks that this account has put out. Like, for instance, if I'm understanding correctly, you'd potentially be able to just Sybil via many different wallets opposed to, doing it all from one wallet. So, on one hand, Solana is innovative and nascent and early in its life cycle. And on the other hand, these problems will likely be difficult to fix and continue for, the foreseeable future.
Yeah, agree there. Right. Next, moving on to Bitcoin L2s. Sam or Matt, do you guys want to take this, or I can take it too?
Sure. There was a interesting tweet, or it was actually a portion of a Twitter space that Eric Wall put on Twitter, where he basically is explaining, what something actually needs in order to be a Bitcoin L2, and why, by his definition, and I guess by many thought leaders' definitions, anything that launches on top of the Bit VM is not actually an L2. Um, Basically, his main point and the way he posed it was because the BitVM bridge does not have permission. It's an optimistic bridge. So basically, it has you have a reliance that at least one validator is actually acting honestly and flagging, malicious transactions. He says because that's not permissionless, because there's no ability for anyone to go be that one validator, that one honestly acting validator, it's not actually a roll up or an L2 by his definition. I think really what he meant, even more so than that, was that there's no ability to exit the system without that one honest actor. So, for instance, Arbitrum is the exact same in that it does not have a permissionless validator set that allows, there's a whitelisted 20 validators who are able to create these fraud proofs and say a transaction is malicious. So very similar in that regard. But the difference is that you have forced inclusion and an escape hatch. So you actually have the ability to get your Bitcoin out of the system, despite this being a fact of the way the protocol is set up. So it was a very interesting conversation. My main takeaway from it is that nomenclature is a big issue, and I think we already all know that. Like, I think that this is most exemplified when we're talking about TVL and rollups. For instance, when I think of TVL and rollups, I like to think about it as L2 Beats definition, which is the total value secured of externally bridged, and natively minted tokens. But if you look at DeFi Llama's definition of L2B, it actually has nothing to do with, the value secured by the rollup, and rather it's all about, the total value in DeFi smart contracts on the total value locked in DeFi smart contracts on the rollup. So, these are just completely different metrics. They're both valuable, but it's important to understand both. And likewise, the definition of what is a rollup is, very up in the air today with a lot of controversy and, people not really understanding, the differences and the nuances between what is a rollup. So, of course, this is going to be a problem with decentralized systems, like who defines what this nomenclature actually means. But it's just, a crazy shit show and makes it really, really hard for someone who's not so deep in the weeds to understand. It's even difficult for, all of us to understand, I think.
Yeah, God knows that 95% of crypto users don't understand the trust assumptions of Ethereum based rollups. So I think for Bitcoin, it's probably like exponentially worse. And I do think at some point that you're just going to see like a really big bug, or like something goes wrong on a bridge contract and everyone's stuck there. There's no forced inclusion. And like a huge amount of TVL or assets are basically gone forever.
I agree, Ren. We can also drop that the link to the space in the show notes, and as well we'll drop some notes on basically different types of proving mechanisms that would need to be enshrined on Bitcoin via soft fork into the show notes as well. I found it pretty interesting. But for the next news update, we've got Informal Systems on Twitter today on Monday announced an integration between I always butcher this, Babylon, there we go, and the Cosmos Hub. And it's essentially enabling anyone to delegate Bitcoin to a validator of a consumer chain. And the consumer chain can actually set what percentage of their security is backed by Atom versus Bitcoin, and that yield will be paid out. Actually, I'm not sure if that yield would be paid out in Bitcoin. Now that I'm thinking through it, that wouldn't really make a whole lot of sense. But nevertheless, kind of an interesting spin on the consumer chain narrative over in the Cosmos ecosystem. Not sure if you guys have any thoughts here.
I think it'll be interesting to watch how much it gets adopted, because one of my main questions is how much dual token staking will be utilized in EigenLayer. So rather than a middleware, a protocol, whatever, being restaked purely by, being secured purely by restaked ETH, a protocol can choose to have a dual staking model where it's partially secured by restaked ETH and then partially secured by their own token. And I think the main reason you would want that is basically you don't want like all of the value accrual inflation going to like restake if you also want some of that to go to your own token. So it'll be interesting to see if anyone adopts like a dual token staking model.
Do you think in your head, in your mental model, would dual staking be to secure different parts of the protocol or ecosystem, or would it be, two different assets that are both able to be slashed if there's malicious actions in the like one part of the protocol?
I think, at least for me, it would be two different assets securing the same thing or like the same components of the protocol. However, I'll caveat with that I don't think that we're gonna see a lot of like dual token staking models. I feel like it's gonna mostly be either if like you use eigenlayer to secure a protocol, and at some point you're like, okay, I'm gonna switch. I don't need this like shared security or like food security anymore. I'm gonna switch to my own token.
I think it's a good move though, because obviously Atom hasn't performed super well, and the security of it is directly tied to the market value at stake. So I think having, I guess, like an exogenous collateral in Bitcoin as a slashable asset is definitely makes the consumer chain value prop a lot stronger. For the next news update that we got, I got Vertex has been teasing Blitz. I've been talking about Vertex for quite some time, so I felt the need to shout this one out. But they have an order book DEX coming to Blast, which is the yield bearing L2 by Pac-Man and Co. And basically, I'm not sure what the relation is between VRTX, the token, or Vertex, the protocol devs, and Blast, but the fact that they're kind of hyping it up on Twitter makes me think maybe they're intertwined in some way. So I found that kind of interesting. And then one other update, Coinbase earnings on the 15th. I believe that is Thursday this week. So definitely know a bunch of guys on the team are excited about that to see what the numbers come in at. I think everyone generally thinks that it will beat analyst expectations, but I guess we'll see. Not sure if a Coinbase run as well would lead to kind of like a base alt season. I think a lot of people are thinking maybe that's a way to get beta exposure to Coinbase equity, but nonetheless, definitely excited to see those numbers.
Now we'll have a quick word from Stride. Thanks to our fantastic sponsor, dYdX. All right, guys, for this week's dYdX segment, we have Vishal, co-founder of Stride Labs, the leading liquid staking provider in the Cosmos ecosystem. So, Stake dYdX recently launched. Can you explain a bit about how Stake dYdX works?
Yeah, absolutely. So dYdX is super interesting, and it's a little bit different than other LSTs. So the way STDYDX works is users will come in with their dYdX and liquid stake it. So what this means is they'll sign some transaction on the dYdX chain, so on liquid stake. Those funds will then get automatically sent to the Stride blockchain and automatically converted to STDYDX, which is delivered to the user. On the back end, what happens is the dYdX Stride will send it to an account that it owns on the dYdX chain. And when we mean by owns, the way Stride works is kind of unique. It's not like this account is owned by multisig or a validator or something like that. It's actually owned by the Stride blockchain. So it has the same kind of trust properties as any sort of POS chain. And for Stride, it's backed by billions of dollars economic security. So it's a very kind of trustless and decentralized custody of these tokens. After Stride gets the dYdX, it goes and stakes it on the dYdX chain. But here's where it starts to get a little bit interesting. dYdX, as some of you may know, doesn't give inflationary yield in dYdX token. Rather, it streams USDC revenue from traders and users of the dYdX protocol to its stakers. But Stride needs to convert this USDC back to dYdX to help to restake it and allow for compounding and all sorts of benefits. And the way it does that right now is, I think, pretty novel. So it takes that USDC and trustlessly sends it to Osmosis, another account that the Stride blockchain owns, and then will automatically kind of trade that USDC for dYdX. And does this, it batches it up, so it only trades once every hour, does in a relatively small size, make sure there's enough slippage. They'll be executing these trades, converts that USDC to dYdX, then sends that dYdX back to the dYdX chain and restakes it. And so from the user's perspective, let's say I liquid stake one dYdX, I get back one STDYDX. The token doesn't rebase, but through time, as you get the USDC real yield, the one STDYDX can be redeemed or traded for more than one dYdX. So in a year, for example, one STDYDX might equal 1.2 dYdX.
That's a really clever design for a token that's, USDC bearing for stakers. So thanks for explaining that. How has adoption been thus far?
Yeah, it's a great question. So we've seen pretty good adoption early on for dYdX, right around $3 million in TVL, with around $1 million in liquidity. We're expecting that we've seen pretty healthy growth on that so far. We're expecting some pretty good traction going forward too, with a number of kind of really interesting integrations with dYdX on lending markets, even stable coins, perp markets, etc., as well as a few kind of custodial solutions kind of coming forward, and a pretty large Stride airdrop for early users as well. So we've seen good growth in that, and we're expecting pretty good growth going forward as well.
I think one thing that users are familiar with is liquid staking, at least within the EVM context, but within the Cosmos ecosystem, right? What benefits does liquid staking bring for users, and perhaps what are the current limitations?
Yeah, it's a great question. So some of the benefits are kind of the same as anywhere with Ethereum as well. But you get so for Cosmos chains, there's kind of this fundamental trade-off that most chains have between staking yield and DeFi. For Ethereum, it's not as large of a concern because most of the kind of base currency is ETH, which has relatively low staking yield. For most Cosmos chains, they care a lot about the chain having really high economic security. For something like dYdX, for example, it matters a lot that the chain has high security so that traders feel comfortable trading on it, depositing large amounts of collateral, and it makes the chain kind of function better. But in order to get that high economic security, the chain has to pay pretty significant yield to stakers. And while all this helps secure the chain, it makes it really hard to use that dYdX elsewhere. So if you want to, for example, mint a stablecoin against your dYdX, or you want to deposit it as a collateral lending market, or even use it on AMM like Uniswap, you're foregoing this 15-20% staking yield that the dYdX token offers. And it generally makes it so very little DeFi will occur on the token. But with liquid staking, you can kind of get access to this yield benefit without having to compromise participating in DeFi. And one thing we've noticed is the rate of which LSTs are used in DeFi is significantly higher in Cosmos than any other ecosystem. And a large part of that we think is because you have this really high kind of staking yield. One thing that's really neat for dYdX is they have a really big priority on MEV, in particular from validators not doing MEV extraction. So there's a whole kind of framework that we can talk about that dYdX tries to enforce on validators about to try to help encourage validators to not basically MEV extract dYdX users. But for a lot of the people who delegate stake on dYdX, a lot of this is totally abstracted away from them. You know, they're believers in the protocol, believers in the product, but not necessarily aware of all the politics of the validators. Liquid staking helps too is kind of provide one layer of abstraction on top of this. And Stride really prides itself in having a really high quality delegation strategy. But Stride tries to take all this stuff into account. So how much contribution is the validator doing to the protocol? Is the validator MEV extracting? Is the validator running performing infrastructure? Are they doing stuff with go-to-market? We can help kind of better the decentralization of the validator set. Two other kind of quick benefits I just want to highlight. One is for dYdX, because there's USDC yield, a lot of users might just want to hold their dYdX position. So they're like, hey, I'm really clean dYdX. Here's a percentage that has my portfolio. And that they're not necessarily checking in every day or every week to do something with the USDC or to reinvest it. But with Stride, you can just hold your dYdX and you know exactly how large your dYdX position is. And it also leads to buy pressure on the dYdX token from users who say, hey, I don't want the USDC. I want that to go right back into dYdX. That's the token I really believe in. The last thing, and this depends on your jurisdiction, but with the USDC, a lot of jurisdictions treat staking income as short-term capital gains or income, or just like dividend income. But dYdX, you're just holding a token that's not rebasing. Under some jurisdictions, it might be long-term capital gains. So for users who want to hold dYdX for a long term, they can significantly make it much more tax efficient to hold the LST version. But there are some kind of limitations and two kind of big ones to highlight. And we hope these will get addressed over time. But one is liquidity. So if you're kind of a large user, you want to hold like a 8-figure dYdX position. You want to have confidence that you can exit that position quickly in order to get maximal utility from the liquid nature of your LST. What we observed is over time, liquidity will build up. Right now, there's right around $1 million of liquidity, which is enough for most retail users, but not necessarily enough for whales. But we hope that kind of liquidity will increase. Another thing is the LST is really useful if you can use it in iteration. So if you can mint stable coins against it, deposit as collateral and borrow against it, trade with it on lots of pairs on AMMs. We have like 6 or 7 integrations for dYdX. We're hoping to kind of expand that to the whole suite of DeFi applications in Cosmos, but also on Ethereum, Solana, etc. Through time.
Wow, that was awesome. That was like a ton of information. We could definitely do a whole podcast on this. So maybe sometime in the future we can do that. But unfortunately, we're out of time here. We will be sure to link to Stride's documentation, the site, as well as your Twitter, Vishal. But thank you so much for coming on.
Thank you so much for having me. Really excited to ask you dYdX and see where it goes.
Awesome. Well, let's get over to Hot Seat, Cool Throne.
All right, moving on to our hot seat cool throne segment. I'm gonna throw it to Sam first. Sam, who do you got in the hot seat cool throne this week?
I got Bitcoin ETFs in the Cool Throne. I'm actually looking at our podcast prep sheet, and I think we've got all Cool Thrones this week, which is kind of funny, but I guess that's what happens when price goes up. But anyways, they collectively hold 3.5% of the total Bitcoin supply, which is over 2.5 billions of net inflows since they launched. And meanwhile, Bitcoin just hit 50K today, so that's kind of exciting. There's this awesome dashboard from Hill Dobby, which we can link to in the show notes as well. Basically shows if the current pace continues, then 2.33% of Bitcoin will be funneled into ETFs each year, which is pretty mind-boggling. And a fun fact, actually, that I feel like a lot of people don't know, the halving block reward is actually equal to the 4-year inflation rate. So today that block reward is 6.25. So that means 6.25% inflation over 4 years, or 1.56% per year. So when the halving hits in April this year, that will actually be reduced to 3.125, which equates to 0.78% of inflation every year, which I kind of find like a fun fact. The passive flows, in my opinion, from the spot ETF approval was just massively underpriced. Like, people did not think it would be that big of a deal, and it's proving in real time to be a very huge deal. Dan mentioned in our chat the other day, actually, just how his parents' friends have been asking about Bitcoin ETFs, and I've been getting the same thing. So it feels like real, like, high signal interest. And not as much like the retail frenzy that we've seen in past years. And on top of that, we still have ordinals rocking. There's a new project like literally every half an hour to an hour. So that's definitely still going crazy. And then we already talked about Bitcoin L2 conversations picking up. So I don't know. I just think this cycle is going to be a lot of fun.
Yeah, I think something that's interesting is how underestimated the ETF flows were. And we foreshadowed this on our analyst hours call, I think in December. I think it was you, Sam, and me. And we were just like, people are still underallocated Bitcoin and they will stay underallocated Bitcoin for the entire run. And like you're seeing that a lot in like the crypto Twitter bubble where people are like, all right, this is the top. Like, we're going to pull back now. And we're like expanding beyond this little bubble that we've lived in for 3 years on crypto Twitter, and we're fundamentally seeing something different that's just going to keep growing.
Yeah, I wanted to follow up there with some more personal data points. My dad asked me about the ETF approval a few weeks ago, I think. And then he basically asked me like, "Oh, I've seen like prices going up. Which ETF should I buy?" And I told him like, I have no clue. Maybe go like support one of the more crypto native ones like Bitwise. If not, BlackRock is always a safe option. And my girlfriend too. My girlfriend, I think she thinks that I'm like becoming rich, and so she's asking me like, "Can I give you like a few $1,000s to put into crypto?" I haven't took the money yet just because I don't want to lose it, but I have told her that if she wants to, she can go buy a Bitcoin ETF. So I do think like eventually as price goes up even more, right, people will be like, shit, like I need to have like some allocation to it. I don't want to miss out on like free money. And I think at this point, like everyone knows how much money that some people made last cycle during COVID. And so the Bitcoin ETF is a very natural entry point for a lot of these participants. And even if like these participants like never come on chain, I do think that those flows are like significant, not just from like institutions, but also like just like normal retail.
I've been seeing that chart float around on Twitter a lot today, though, like Google search interest for the word Bitcoin, and it's still super, super low. Like that, I think that I don't love looking at that metric and putting too much weight to it, but I do think it's a testament to the fact that not many of my normal friends who like don't pay attention to crypto, like they have no idea Bitcoin is only 15, 16, 17K off all-time highs, which is just kind of wild.
I also add on that I think I've seen some discussions or from like the Bloomberg ETF guys about two, I'm not sure if this is the correct term, like index funds or sort of like investment options. And then they basically allocate between like 60% stocks, 20% bonds, 10% like emerging markets or whatever. And like a few of these have started to include like a 1% or like a 0.5% Bitcoin allocation. And basically the bet there is that like people will allocate to these like diversified portfolios which have some small percentage of like a Bitcoin allocation. And over time, like I do think the flows from there will be relatively significant. I'm not sure how this information is displayed to users, but if you did like a back test, right, of this like diversified portfolio, the one with like a 1 or like 2% Bitcoin allocation would probably wildly outperform like the one with like 100% S&P, because that goes up like 10% on average every year. So perhaps like that would be kind of like a self-fulfilling prophecy, but also like a little bit reflexive in nature.
I wish I could find the tweet. I lost it, but one of the Van Eck guys or one of the Bitwise guys tweeted this morning and was like, I think it was like 6 or 7 times as much institutional capital was now exposed to crypto as before the Bitcoin ETFs launched. Don't quote me on that again. It was just a tweet, but it was from one of these reputable sources, and I think it was 6 times. It was like 1% of, I want to say, financial advisors advertised that they were allocated or their clients were allocated to crypto, and now it's sitting at like 6 or 7%, if I remember correctly. I definitely agree. It feels like no one, even if your parents are asking you like, oh, what do you think, Bitcoin ETF, Coinbase stock, like, are these things that I should be getting interested in? It's not at all like a level of craze where your friends are texting you about, some ghost chain scammy AI coin, which is what I would expect once we reach the mania phase. To me, it feels a lot like it did when Bitcoin first surpassed 20K surpassed 20K after the bear market in 2018, 2019. And, for us, it's like super exciting. Times are interesting. There's lots of cool stuff going on, lots of cool things being built. But for the rest of the world, they're like not paying so much attention yet. And it's always interesting how the mania phase doesn't really start until we're at the point of like, oh, this stuff's all, the mindset of a crypto native at the point when mania starts versus at a time like now changes completely as well. So I guess just all things to be aware of and like keep in mind when you're thinking about starting when to de-risk and remove exposure to the space.
I just think it's wild too to zoom out and think like Apple's like a $3 trillion company and Bitcoin's like a $1 trillion asset, like, which is 50% of the entire industry's market cap. So I don't know. That's just like mind boggling if you think about it, and it's an entire asset class. So I'm definitely excited for the years ahead. But Ren, who you got in the hot seat? Cool throne.
I got another coup drone this week. It also helps when price goes up. I have CleanSpark on the coup drone this week. So CleanSpark is a Bitcoin miner. I want to say they're maybe the third or fourth largest. They announced their Q4 2023 earnings last Thursday after market close, and since then they have basically gone up by 100% or doubled. Um, Overall, all of the other miners have also proceeded to Fusen. For example, today Marathon is up 12%, Riot is up 9%, and it seems like Wall Street is kind of finally pricing in like both the ETF flows, but also it's kind of like the positive impact on BTC miners. So for some statistics on CleanSpark specifically, their quarterly revenue increased from 27.8 million to 73.8 million year on year, which is a 165% increase. Their net income increased from negative 29 million to positive 25.9 million. So it went from a negative 46 cents earnings per share to a positive 14 cents earnings per share. And their adjusted EBITDA increased to roughly 69 million from negative 2 million year on year. So I feel like I've been boo posting about Bitcoin a lot on my Twitter. And it's good to see that the market's like finally pricing that in. And even though like all of the data is on chain, especially in December, which was kind of like a blowout month for ordinal activity. If I'm not wrong, out of the total sort of miner revenue, 17% of that was from like ordinal activity and transaction fees. And I just don't think Wall Street priced that in enough, right? If not, like if the market was like even close to efficient, CleanSpark shouldn't have ripped 20% after market close and then 30% the next day, which is like basically 50% in like 12 hours after announcing their earnings. And I think another thing to note is that the Bitcoin miner infrastructure war is obviously heating up a lot, right? On the back of the halving, which is coming in roughly 60 days or so, CleanSpark's hash rate surpassed 12.5 exahashes per second, and they have a strategic call option to purchase 160,000 Bitmain miners for a path to 50,000 exahashes per second. And there's like a crazy amount of miner infrastructure investment last year. If I'm not wrong, the number was 1.2 billion in mining machine purchases. And I wouldn't be surprised to see that heat up even more this year. So, any thoughts on Bitcoin miners?
I'll just add that it's really awesome to see for the first time ever that Bitcoin miners are making more money from the transaction fees as opposed to block rewards. So there's finally this vision for, sustainable security for Bitcoin. I know a lot of people on our team always had this, fundamental issue with Bitcoin in that in their heads, there was no way for the network to sustain its security while block rewards were going down. In other words, eventually, once enough halvings happened, whether it was this one or the next one or the next one, the wouldn't be profitable to be a miner anymore, and the network would start losing security. So finally, seeing multiple days over that past couple months where more of the block of a miner's revenue for mining a block was from the transaction fees as opposed to the block rewards is really, really cool, and it gives us a way for us to envision how Bitcoin can be sustainable and have sustainable security into the future. So shout out ordinals. There's a lot of hate for them, but at the end of the day, I think in my head, anyone who says that ordinals are net bad for Bitcoin is mentally ill, has something wrong with them, because this is really, really, really good.
I think Riot's pretty interesting too. Just want to call out the fact that, they once the electricity prices in Texas get to like a certain ridiculous point, they just sell that extra energy capacity back to the grid. And that's like another way that miners are starting to like scale their revenue and diversify their revenue, I guess I should say, through different mechanisms as opposed to just directly mining Bitcoin. And I think we'll see a lot more of that. I think that's the beginning of a bigger trend and not just like some one-off use case.
I'll also add that I think there's obviously the big catalyst for Bitcoin in terms of the ETF flows, but also like Bitcoin really didn't have anything other than Bitcoin last cycle. Whereas this cycle, you have like L2s, ordinals, like different like VMs made for Bitcoin, and probably like one of the best ways to get exposure to that, other than Bitcoin itself, is this Bitcoin miners who will benefit from all of the ecosystem activity, the developer mindshare, the additional transaction fees. And there's a great Spartan report that they put out in December last year with basically an overview of the entire Bitcoin ecosystem, including like ordinal infrastructure, L2s, VMs, whatever. And I feel like it's definitely worth paying attention to, not just like Bitcoin the asset, but also Bitcoin the ecosystem.
What's up, everyone? March is approaching fast, and I want to give you another reminder not to miss out on DAS London. It is coming. It's right around the corner, and it's in March from the 18th to the 20th. We have 3 full days of content. This is your chance to bump shoulders with some of the world's top executives and have open dialogue with both attendees and speakers. We're going to be focusing on a range of topics that I'll let Ren discuss for you.
First on the list, we have Bitcoin Catalyst, the halving and spot ETF. Next, we have a view from the buy side from investors on things like strategy, portfolio allocation, and more. We also have a topic on RWA's tokenization and stablecoins, which I think we can all agree are going to play a large role in crypto's future. We'll also talk about global regulatory frameworks like compliance best practices and the evolution of global standards that are shaping the global investment landscape. We'll also have someone from the institutional front to talk about infrastructure such as banking and payments with financial giants like Visa and JP Morgan. And last on the list, the macro case for digital assets. So don't miss out on this monumental event. Seats are limited, so be sure to register today by hitting the link in the description and using the promo code 0x10 to save 10% on tickets. See you in London. Next, we'll pass it off to Matt. Who you got in the hot seat? Who's throne?
I also have a cool throne today. So I'm going to hold ARC21 shares in the cool throne. They've recently added some language to their Ethereum ETF application that includes, the ability for them to stake the assets to drive more revenue to holders of their ETH ETF if it gets approved. This is really, really cool. Basically, if you hold ARC21 shares, Ethereum ETF, if it gets approved and launches, you'll also receive staking rewards. So not only does this mean, potentially a good way to get exposure to Ethereum, or at least if, I don't think anyone would want to hold ETH ETFs that didn't have that exposure, at least no one in this room would. So very good for us, but also interesting and amazing to see institutions, wanting to be involved in staking, being sophisticated enough to have the infrastructure to do so. So very, very cool. Good for you, ARC21 shares. And hopefully that, we see this narrative start to kick off throughout the year, whether it be, this month, next month, or Q2, Q3. I think that Ethereum will have its moment in the spotlight. I don't necessarily know if it's going to be the best performer throughout the whole year, but I do think definitely ETH ETF, something that's imminently going to start being talked about, and ARC21 shares probably at the lead of it.
Yeah, one thing that's interesting about this is wondering what staking provider they're going to opt for. Is it going to be Coinbase ETH? Because if so, then it's going to feed Coinbase revenues, and then Coinbase stock will continue to rip. Or they could just do their own thing with like Figment. But then you have to wonder, at what point do people deem something like Lido to be safe enough to institutionally stake assets in, like when they want to sidestep some of those Coinbase ETH fees and get something that's a little more EV. Another thing that's important about this is just the development of DVT, especially with someone like Obel Labs bringing their Charon or Karen client to market. I don't know how to pronounce it. So far, only EtherFi is using Obel so far, and that's the only well, there's also SSV, but so there's two DVT plays on the market right now. And I think prioritizing validator uptime and just geographic dispersion is really important, especially as more and more institutional assets come in.
The LST angle is actually really interesting to me because my main qualm with it was you're going to have a certain amount of liquidity. So like I thought maybe like it would only be allowed to be like 10, 15 or max like 20% of assets under management to be actually staked. Because if you get into a scenario where everyone's selling and then you have a long withdrawal queue, then obviously you don't have the underlying to sell in order to make sure you're even on the books. Or maybe they could do some hedging through derivatives. I don't really know. But the liquid staking angle is pretty interesting just because you'd have that added liquidity. Obviously, then you introduce peg strength risk, but nonetheless, I feel like that'd be a much more attractive avenue to go, and obviously bullish LST providers.
Yeah, I'm actually gonna talk about the DVT angle too, because I think that's also very interesting. If you're, securing very, very large amounts of ETH staked, it makes sense to be using a DVT solution. So OBOL and SSV, which really haven't had so much, haven't really been looked at or really caught a narrative yet, definitely could be a catalyst. These ETH ETFs for them, if there's any partnerships there. There is also a third play outside of SSV and OBOL, that's DIVA. So OBOL does not have a token. Interesting one to potentially farm, because likely they will have a token in the future. Diva does have a token, but it is not transferable, so you can't buy it, can't sell it. But they did like an airdrop a few months back to, I believe, holders of LSD tokens and a few other parties. But Diva is actually like an LSD DVT solution, so it's got, instead of just being a DVT layer where anyone can go and launch their own validators with this technology that have multiple node operators for a single validator. With Diva, it's actually the full stack all the way up to the LSD token itself. So yeah, would definitely be paying attention to that space as the Ethereum ETF narrative potentially gets closer to, become catalyzing and being a catalyst for these DVT protocols.
I'm not sure if I'm thinking about this completely wrong, but assuming ARK stakes like some portion of their ETH in this ETH ETF in to something, isn't like the ETF stock or like shares of the ETF kinda a liquid staking token? Because you can use that, you can like borrow margin against it. Like that would have its own peg. Like I have no clue how to think about like the liquidity and like peg risk, given that now there's like a off chain LST with like a on-chain like staking component, and I probably need to think that through a bit more. But I think that would be like a really, really interesting dynamic. I also wonder if Lido would ever introduce like a institutional version of Lido where only institutions can stake. They have like a whitelisted validator set rather than eventually expanding to like 5,000 validators. Kind of similar to how like say Aave 2 years ago launched the ARC, which never really turned out to be anything, but that was like just for institutions only, because institutions do have very stringent requirements on what they can do, right? Like, for example, if you're an institution, you're listed, I don't think you can interact with any contract that has had a Tornado Cash asset, like even just pass through it before. So if like I send some like Tornado Cash ETH to like a specific validator, like is the regulator going to come after me? And I don't think that that's something that an ETF issuer or like a custody, I don't think that's something that they're going to want to deal with. So I feel like they're going to adopt institutional solutions. And for now, it seems like Coinbase is the safest option. Obviously, they have like that 25%, I think, take rate, but also they're like a qualified custodian, and there's only so many qualified custodians within the US.
as a coin stockholder, the thought of a 25% fee revenue on Ethereum held at an ETF is just absolutely puts a smile on my face.
Yeah, I agree with your last point too, Ren, in terms of like having to be OFAC compliant aware and maybe having like a whitelisted validator set for those kind of solutions. Although I don't think any of us here are super keen on that idea, but unfortunately, I think that's just like the reality of the situation. And back to your comment on like, does this become an LST? That is really interesting. It's like we just talked with Stride. You guys just heard that in the dYdX segment a minute ago. And are they going to take the ETH and just put it back in the trust and then your shares are redeemable for more? Like, I don't understand how that'll actually look in practice, but it'll be fun to watch that play out.
All right, Spencer, you want to hit us with the last hot seat coup thrown?
Yeah, so this actually continues to play into the ETH ETF thing. Dencun is set to go live on ETH mainnet on March 13th, and this is a huge moment for the Ethereum community, who has just been bag holding while everything else rips for the past few months. But one thing that's neat about this is it has EIP 4788, which is going to kind of replace the need for custom oracles for liquid staking solutions. Because right now, Lido, Eigenlayer, etc., they have to use these complex oracles that are also a risk for reporting beacon chain validator data. So this is a huge like necessity before you start seeing this broader staking narrative pick up, especially with like Eigenlayer set to like actually provide some AVSs in the near future. Another cool thing is obviously EIP 4844, which is going to introduce data blobs, and that's going to kind of set the foundation for dank sharding in the future. I think L2 tokens are kind of primed to rip off of this because transaction fees are going to go down significantly. And hopefully you see some applications arise that will just bring on a whole new wave of entrants to the L2s, especially as ETH mainnet just continues to get more and more congested as more people come on with the price going up. One final EIP that I'm looking at is transient storage, which is going to lay the foundation for Uniswap v4, which is moving to a singleton contract, and it's going to have its own flash accounting system. But basically, it's just going to like optimize smart contract development to where you can do a lot more interesting things within the contract.
I think out of like 4844, which is like the very obvious one, I think EIP 1153 is probably the one that I'm most excited about. I'll be interested to see a few things. I think Ambient launched on Ethereum after they launched on Scroll. And so it'll be interesting because Ambient also uses like a singleton contract model. So it'll be interesting to see like how does ambient volume or like liquidity respond to EIP 1153 or more specifically Uniswap v4 going live. Another thing that I'm excited about is Uniswap v4 hooks. I feel like hooks are maybe like the frames moment for Farcaster. It allows like anyone to build kind of anything that you can code, right? Depending on like specific events happening, whether that's like depositing liquidity, withdrawing liquidity, tipping to liquidity providers, or making a swap. And I think there are some really interesting hook ideas that are going to appear over the next, say, half a year or so that may have implications both for liquidity providers, sort of like top of block MEV, and also sort of just general uni ecosystem, so to say, because it goes from like a DEX to like this like crazy ecosystem where people can build like all of these different hooks. But I also think with that it comes like a whole host of problems. Like what if someone just copy and paste a hook, governance, turning on a fee switch? But that's probably a problem for later.
I just agree with Pibblez on the L2 token narrative. I mean, mainnet is literally completely unusable right now. Like, there's nothing going on in Guays at 100 plus. Like, that's insane to me. I've been seeing a lot more cries on Twitter of why don't we like try and optimize the base layer a little bit more within Dencun, or like maybe like an upgrade after that. And I would personally really like to see that because you just can hardly even bridge through Ethereum without paying a $50 transaction fee, and that's just horrible UX.
Yeah, I'm pretty done doing things on Ethereum, to be honest. Like, it's just, it prices me out, or maybe it's not even the pricing me out, and it's rather just the UX on L2s and on Solana and everywhere else is just so much better at this point. especially for cross-chain stuff. Like you mentioned, you can't bridge through Ethereum. Like if I have assets on Ethereum and I want to go buy something on Arbitrum, I'm looking at, current rates like $50, $100 fee. So yeah, I do agree. I think there has been some conversation about doing small things to help with making block space a little bit more abundant post Dencun. This would not be anything including an upgrade and a fork. It would rather be at the validator client level, the node client level. So hopefully we see more progress there. I know Justin Drake and Vitalik were both in support of it, so likely that's a very good foundation for it to succeed in making block space more abundant. I would disagree with both of you guys. Like L2s and Uniswap are both poised to catch a narrative with Dencun, and I will most definitely be getting myself exposed to those tokens at some point in the future, at least for a short period of time. Uniswap specifically, I think, is kind of slept on. I think everyone knows, or at least not everyone at all, but everyone within our circle knows about how Dencun impacts L2s, but I think it's a little bit less known about how it impacts Uniswap. So I do think that's a very interesting angle to look at it from.
All right. Well, I think that's a good place to call it. We got a quicker episode today, but thanks for coming on, Pibblez and Matt. We will see you guys here next week.
Hey everyone, thanks for watching today's 0x Research episode. I wanted to take a second and remind you about our upcoming 2024 Digital Asset Summit in London this March. Seats are limited, so hit the link in the description and use the promo code 0x10 to save 10% on tickets. See you in London.